Hello, everyone, and welcome tonight to the London branch CPD. Peter Taylor, the chair of the London branch, here to introduce Angus Osborne-White, head of technical development of Crawford Forensic Accounting Services. But before Angus enlightens us on bridging the gap, I just want to let you know that the committee is currently trying to organise a get-together in November, where we hope to be able to meet you in person, be an informal event. So keep an eye out on your emails for when that is advertised. But without further ado, and also please make sure to put any questions into the chat, and then we'll interrupt Angus and ask him away. So Angus, over to you.
Brilliant. Thank you very much, Peter. Yeah, as Peter just mentioned, if you do have any questions throughout, please drop them into the chat. I do like to get a bit of audience interaction rather than just listening to me for the next 45 minutes or so. So the title of this evening's talk is Bridging the Gap, and really that's sort of an indication between the great work that you all do in terms of the risk management piece and how you sort of get to a point of recovery using insurance where applicable. So this is what I'm intending to cover. We'll go through sort of I'll introduce myself and Crawford, what we do, a bit about loss adjusting, and then link that into sort of the slightly more technical details around business interruption, specific covers that you can get, and I say getting it wrong, the sorts of things that as a loss adjuster we would like those that have involvement in setting the covers, what we'd like them to get right, so that when we turn up, businesses have got sufficient cover, and we're not worrying about any issues with there being no cover and potentially not being able to help get the business back up and running. I've got some photos, some case studies that we can talk through, and then as I say, questions throughout would be great, but we'll have a bit of time for wrap up and any Q&A at the end. So start off with introduction. So my name's Angus Osborne-White. As Pete mentioned, I'm head of technical development at Crawford Forensic Accounting Services. I've been working in insurance and commercial risk management since I left the army in end of 2013. A slightly unusual sort of background to come into accountancy, but here I am, and there's probably not many accountants out there that carry a full set of PPE in their car boot, ready to go to sites where there's been fires. I sort of try and specialize in a few different areas. So some are up there. So agriculture, we have quite a strong agricultural presence, and renewables kind of goes hand in hand with that sometimes when you think about the ways that farms are having to diversify these days. And I suppose as I've gained more experience, I end up dealing with sort of larger, more complex claims. So part of the reason I love this job so much really is the variety that I get. So I might be talking to a colleague about sort of £10,000 dental business interruption claim one moment, and then the next moment I'm talking about 100 million dirham claim in Dubai for a hospital the next moment. So really do get a lot of variety, and I'll come on to the sort of the time scale or the life cycle of claims in a while. But for me, it's like that second picture there, the ability to get out with the lead adjusters and working with businesses to try and get them back up on their feet, back to the position they were in prior to the loss. So, who are we as Crawford? I would hope that the majority of you may not even be aware of who Crawford are, what we do. We're one of the largest claims management companies globally. So we're headquartered in Atlanta, and our purpose is there, and it's a bit of a tagline. But the purpose of our business really is to help people that have had insured losses get back up, whether that be personal claims, so domestic claims we'll deal with, through to sort of the large hospital claims that I was talking about earlier. And just sort of some wider context, you can see sort of $18 billion a year claims managed annually, and this was back in sort of 2022. So there's probably a bit of growth since then. And usually, I know that sometimes these CPD things can come across as a bit of a sales pitch. To be honest, we're not looking to sell to you. All our clients, few exceptions, but all our clients are insurers, and so sort of at a personal level, we hope never to cross paths. Unfortunately, we do though. And so the sort of tools that we have across the business are, as you can see there, so loss adjusting, which is what I'm going to talk to you tonight about, specifically the business interruption aspect. But then we'll also do things like third-party administration. So that's where we effectively kind of manage call centers on behalf of insurers. So an insurer might not they might not have the appetite or the resources to man their own telephone lines, and therefore we will do that for them. Managed repair is where we will use our contractor network. So we have a network of pre-approved contractors that will again assist the insured. Medical management we kind of do less of in the UK, but we have sort of teams of people that are knowledgeable in that area. And then on-demand inspections, again, predominantly US based, but we have a platform called We Go Look, where insurers and other organizations can use the services of what we call lookers, and they're an army of people that will on demand, a bit like I suppose requesting an Uber or requesting a Lyft, Deliveroo, etc. You can put a request in that somebody goes and looks at something. They'll take photos, do a report if that's necessary, and then report it back through our platform. And then the final one there is catastrophe response. So quite often there's sort of an annual cycle of typhoons and hurricanes across the globe, and the benefit of Crawford is the number of people that we have globally. We can go out and adjust a greatly significant number of claims in a short period of time. Sort of the typical scenario that we get is, as I say, typhoons or hurricanes, but it also applied. So during COVID, we dealt with, considering we probably within our team, within business interruption team, we might deal with, say, 1,000 claims a year. We had a necessity to deal with about 4,500, which our team couldn't sustain on its own, and therefore we were able to bring into the process colleagues from Australia, colleagues from America, and sort of effectively service the policyholders in the short time that they required. And so we do try to use various platforms, technological innovations where we can, and that's kind of where my role sits within CFAS, is looking for ways that we can service the policyholders that we work for better. So I've already mentioned the sort of We Go Look platform. We have a number of different portals for, say, livestock valuations, submissions of personal domestic claims, and the most recent development that I've worked on has been the use of open banking. So some of you might be aware that the open banking system, it allows you to connect your bank account to third parties. If you've got your own personal bank account, which I'm sure we all have, there's an app called Emma. You can link your bank account to Emma, and that will check through for things like multiple subscriptions to the same organization, that kind of thing. And what we do is we can use that on a commercial basis, use a bit of machine learning. That's not quite AI, but we can use that to categorize transactions in order that we can create sets of management accounts that will then feed into the work that I'll talk about in a bit. And sort of looking specifically at the forensic accounting services that we do, the bulk of our work, probably 90% of our work, it relates to business interruption. But we'll also look at things like stock reconciliations on large stock claims, fidelity guarantee, cyber risk. So obviously a big sort of growing area in insurance is the risk of cyber losses, and so on and so forth. Got a question from Stephen. Hi, Stephen. Victims of cyber attack may have a claim for business interruption, but would those in supply chain be entitled to claim for business interruption caused by an attack on the business at the top of the food chain? So I'll talk a bit about extensions in a little while, but there may be scope for that to happen if there is both sort of a supplier extension or a customer extension, and also it needs to be specific to cyber. So like all these things, I can answer sort of generic questions, and if that is a specific risk that you're looking at, then I'd advise that you speak to your broker. It might be that it requires going out to a specialist market. So generally, that kind of risk might end up with sort of Lloyd's specific coverage. But yeah, potentially the cover is out there. It depends how broad a coverage you want, and whether you can find the broker that will provide it. So that's a bit about who we are, what we do. Obviously, I've had a few lectures on my time in terms of wider risk management, and we are really looking just at this transfer bit and how you as businesses will have transferred the risks that you want to continue to take, but transfer those out. So assuming that you have insurance coverage in place and you've transferred that risk using that insurance contract, and that risk materializes, assuming that loss is of a reasonably significant amount, so we would generally, as loss adjusters, get appointed on most stuff over sort of £5,000-10,000, you'll end up seeing a loss adjuster get involved in your claim. It might be that the people I'm talking to are broadly familiar with loss adjusters. I'll be brutally honest and say that when I got told, got accepted for an interview for a role as a loss adjuster, I then found myself frantically looking at what a loss adjuster did in the car on my way to that interview. So effectively, the Chartered Institute of Loss Adjusters is our professional body, and we do see ourselves as sort of second responders, a bit like the AA refers to themselves as the fourth emergency service. We're there immediately behind the fire service, and those other sort of first responders, to work with policyholders, insurers, in order to reinstate the business, get it back up and running, and hopefully to the same extent that they were prior to the loss. I sort of hesitated a little bit there. I say sort of to the state they were prior to the loss, or better. There is something called the principle of indemnity, which is sort of case law that we have to study, and that the idea of indemnity is that you can't be better off as a result of a loss or as a result of the insurance payout than you were prior to the loss. However, inevitably we see businesses that really sort of adopt a great strategy post loss and are then able to like really form a stronger position on their way out of the claims process. So, assuming that you have a loss and you're insured and they appoint an adjuster, generally will come out on day one, and you'll have a lead adjuster that will come accompanied with a number of sort of experts that will help advise. So that will be anything from the likes of myself as a forensic accountant, through to surveyors, through to forensic experts. And the idea of that day one site visit is purely a sort of data and information collection process. From my perspective, as the accountant dealing with the business interruption, what I'm looking for is to make sure that the facts about the business, as sort of discussed on the site, align with what's in the policy. But really, the main thing that I hope to get out of that is a really sound understanding as to what the business is, what it does, what the interactions with customers and suppliers is, because all of those things are going to be key to how the business might mitigate the loss going forwards. Once we've been on site as a team, we'll then have to review the policy, what the covers are under that policy, how those covers might apply. So, for example, if it's a flood claim, the loss is flood, it is flood one of the perils noted on the schedule at sort of the most basic level. We'll then have to report to insurers. So insurers normally expect that report to be with them sort of probably within a week, unless there's sort of complicating factors. And that will include all those details that we've identified on site, together perhaps with preliminary forensic findings. So a forensic scientist might be appointed in order to ascertain what was the cause of the loss. We'll use their input to go into that report, and within that report we'll provide recommendations. So insurers want to know, well, how much might this loss ultimately be, and so we're having to forecast out at that stage potentially quite large sums at quite an early date with very little information. The idea being that they can then reserve accordingly and make sure that they've got cash holdings sufficient to cover the payout when they need it. So yes, thanks, James. So your understanding principle loss adjusting, is the claim valid, and then ensure the insured is treated fairly under the conditions of policy is that in a nutshell, really. So all things being well, the coverage is in place, it's sufficient, there's no concerns about the cause of the loss. We'll then get insurers will confirm acceptance of liability, and on the basis of that, we can then proceed forward. And as you might imagine, the process becomes a lot more amicable after that, because we can really get involved with helping to set everything on the course to recovery. So we'll manage the claim, and that involves communicating across all stakeholders. Obviously, insurers will want to be aware. Policyholders, your businesses will want to be aware of where you stand in terms of, well, if we do this, will this be paid for? Is this under coverage? And so sometimes it becomes a bit bit grey, we might have to refer back to insurers. We can then look at calculations. So in the business interruption side of things, we can look at your historic trading data, look at projecting that forwards and what that might look like. We can discuss that with you and establish, well, this is what we've calculated. Do you agree? Is there something that we've missed in our analysis? And then potentially go through a stage of negotiation and ultimately settle at the point that everyone is happy with the outcome. It might be that the settlement is 18 months, 2 years down the line for a large loss, and so any business would potentially have cash flow issues if they were waiting until that endpoint to receive a payment. So we do have the process of being able to recommend interim payments throughout. So some insurers are particularly good at this and allowing us to recommend quite hefty interim payments early on. So I've recently finished dealing with a claim for a large pub restaurant, and insurers there were able to pay quite hefty interim payments early on in the claim, and that helped with the cash flow, so they could pay contractors, they could pay for mitigating actions, things like expediting payments for contractors. James, I'll just hold that question at the moment in terms of being underinsured, because I'll come on to that when we talk about what can possibly go wrong. That's sort of the high level life cycle of a claim and how that would go through. When we look specifically at business interruption, we require something within the contract of insurance, within the policy wording and the schedule that triggers the business interruption. So we had earlier from, I think it was Stephen, mentioned about cyber. So it might be that your contract, your schedule details cyber in there, and a cyber event, however that might be defined within the policy wording, is sufficient to trigger the business interruption policy. We have a technical term called material damage proviso, which stems from the early days of business interruption. And as an insured, you might have one contract with an insurer that says they'll pay for your material, your physical damages, and then another policy with a business interruption insurer that will just cover your business interruption. And the material damage proviso effectively said, well, if the property damage insurer pays out, then we'll consider the business interruption triggered also. These days, a lot of policies are on a combined basis, so most of you will probably have one policy that covers both property damage and business interruption. But the principle still really applies in that generally the business interruption will only start in the event that there has been physical damage. There are a few extensions which I'll talk about in a little while that sort of remove that physical damage requirement, but that's generally the position that we have. And so then you generally get two different flavors, for want of a better expression, of business interruption, and those are gross profit coverage or revenue coverage. Sometimes your revenue coverage might go under a different name, like income. Generally, the calculations will be worked out the same. The issues that I'll come onto in a bit about underinsurance generally really arise under gross profit, because some people don't understand the way in which the gross profit is calculated. As an accountant, I might refer to gross profit as the profit that's available after after taking into consideration all direct costs. So those direct costs might be materials, might be labour, might be utilities, carriage, freight, etc. Credit card charges, even in some circumstances. However, when you look at a insurance policy, when it talks about gross profit, it'll be very specific. And so the biggest issue, and for those of you that are involved in setting the business interruption coverage, one of the key takeaways I'd like you to take from this is just double check that you're, if you are on a gross profit coverage, that you've calculated as per the policy wording. We sometimes see people that have used perhaps a 20% rate of gross profit to calculate their sums insured. But when we look at their accounting information, it might be that perhaps only 10-20% of their turnover is spent on purchases, and that's all that the insurance policy takes into consideration. So you're then looking at a 80 or 90% rate of gross profit. And if you think that somebody might have set their sum insured at 20% instead of 80 or 90%, you can see how underinsurance might suddenly come into play. So you'll either have, so the gross profit or revenue will be an either or. You will also have something called increased cost of working, generally in all policies that have gross profit or revenue cover. Those really are there to give the business money to spend in order to mitigate the loss. And the idea of increased cost of working is that insurers will pay out for anything that is going to save them more than they have to incur if that mitigation measure isn't undertaken. So, excuse me. So, for example, a great example that I dealt with once was a pub that they had a kitchen fire, and so therefore the kitchen was taken out of action for a period of time. Front of the house area, so the sort of table seating areas, were smoke damaged, but they could be quite quickly cleaned up. We were able to get hold of a business that would provide a temporary kitchen, temporary modular kitchen that could be connected to the building using a covered walkway, and the money spent on that was less than the money that would have been lost had they just closed down for the whole 6 months. And so, as you might imagine, insurers are quite happy to spend that money in order to reduce their overall loss. Additional increased cost of working you will see as an additional item on your schedule or your policy, and that provides similar coverage, but goes above and beyond that, in that as long as the money is necessarily and reasonably incurred, it doesn't have to be economic, so it doesn't have to be less than the amount saved. We don't often have to dip into that element of coverage, but it is really useful when during those first couple of weeks, there might be a lot of uncertainty as to whether something is going to be an economic mitigation measure or not. And that additional increased cost of working really allows us to go to insurers and say, this business needs to spend £100,000 on this. We've calculated a range. It might be between 50,000 and 200,000 that it's going to save. They've got additional increased cost of working. That will cover it if there's any uncertainty now, and we can work it out. We can work out what the true economic aspect of it will be later on in the claim. And it's not quite a blank check, but it really does help that early part of the process in recovering the business. And And as I'm sure that you can all imagine, any uncertainty that you can take out of the process is really a great help. And I'll talk a bit later about sort of business continuity plans and that kind of thing. I've touched on it a few times now, and Stephen mentioned earlier in terms of the cyber bit, but we do also have contingency covers out there. So those are covers that don't rely on the material damage proviso. The one that lots of people will probably be familiar with over the recent last few years will be COVID. So COVID, where it was covered, was generally covered under sort of a notifiable disease clause or a sort of restriction of access type clause. So these covers, as I say, they're ones where there isn't a requirement that there is material damage that's occurred, and it can be for a wide variety of different types of incident. So the ones that sort of trip off my tongue at the moment would be so the restriction of access, the disease coverage, the utility supply. So the utility supply would be where there's an interruption to either your power, your gas, your water. Also have supplier or customer extensions, which effectively still require a material damage to occur, but it displaces that requirement from the business's premise, or the insured business's premises to those of the supplier or the customer. So the sorts of claims that we get there might be that an insured supplier has a fire at their location. Our insured then is unable to get the raw materials or other supplies from that business like they ordinarily would do. And in some cases, that supplier might be a key industry player, and therefore you've suddenly got a significant excess of demand over supply. And by going to any other organisation to purchase those materials, it's going to cost a significantly greater amount. And that's where things like the increased cost of working or additional increased cost of working covers might allow for the business to pick up, recover those losses from the insurers. So in terms of what can go wrong, there are a number of things that can go wrong when we get out to review a loss and what's happened. I suppose it's probably one of the less common ones, but the level of cover. So sometimes these can be quite technical. So I mentioned earlier in terms of utility supply type extension. There's two main types of utility supply cover. One is what's called terminal ends, and the other is sort of generally a utility supply damage type cover. And it's quite common for people not to read the detail of what the coverage is. With the type of cover more prevalent, there's a requirement that damage happens for that type of cover. There's a requirement that damage happens at the supplier's premises. So generally, we're talking about transformer sites. It becomes a bit more sort of remote, but generating stations, and so the sorts of claims that you get there are going to be slightly different to where you have the wind blows a tree down on an overhead power cable system or something like that. and those claims will only be picked up by a terminal ends cover. So if you are, for example, if you have responsibility for sites that are out in rural areas that have that are supplied by by elevated pylons, that's the sort of thing you want to be looking at and talking through with your broker and saying, well, we think that there's a risk that we could have wind blowing down our supply cables. We need to make sure that we've got terminal ends cover rather than more generic type. Sums insured is probably the most predominant issue that we have, where we have underinsurance. This comes back to sort of James's comment earlier in the comments, and what I was talking about earlier in terms of specifically gross profit, but also things like if you're on a revenue cover and you've got 3 years worth of cover, making sure that the number that you give to the broker and subsequently the insurer is representative of what you'd expect over the 3 years, and you're not just giving them your annual figure. So I think the key ones there really from the business interruption perspective are sort of rates of gross profit, giving the annualized sum rather than the sum for the maximum indemnity period. But we also get issues across the piece. So on material damage, it might be that a survey was done 10 years ago and figures haven't been updated to account for inflation, and so you might have a value at risk on your, or sum insured on your schedule that is £10 million, but if that was based on a figure put together 10 years ago, then it's probably more likely to be 16, 17 million pounds value at risk. The risk for you as a business, if those figures are incorrect, is that in all likelihood insurers will apply something called average, and it means that if the cover that you've got is only if the cover that you've got is only 50% of what should be covered, then the payout that you get for that element of the claim would only be 50% of the loss. As I say, it would be particular to each head of a claim. So, for example, on a if it's your business interruption that's underinsured, then it would only generally apply to that section. And then, in fact, I'll just answer these questions here. So, James has asked about solar farms cover under business interruption for the loss. So yes, we deal with quite a few solar and other renewables type claims, and stolen copper cables is quite a key one. We have also, and this was a concept that's quite alien to me when I got my first one, but we have also had claims for that utility supply type claim where the supply to the solar farm has been severed, and therefore the not only can the solar farm not export, but a lot of these systems need an electrical supply in order to function, to record SCADA data, etc. And so yeah, it kind of end up with both sides. So Stephen's also asked about why will insurers not agree to a cap cover on a building converted church as an office which had a value of 400,000 but was assessed at rebuild cost of 2 million. Wanted a cap cover at 400,000 because of worst case. It's worth talking to your broker in a bit more detail about that. I don't know whether that was a risk that you tried to place directly. If you go to some brokers, they might be able to go to insurers to put in something called a sort of first limit of loss type cover. generally, and I don't know whether um, I don't know whether in your case you had a sort of business interruption cover alongside it. I think insurers would see the risk of not covering the full sum insured as being, well, if if they only pay you 400,000 and oh, it was yeah, the only thing I could think of then in that case would be that if you only want 400,000 cover, but the insurers know that it's going to cost 2 million to rebuild it, then if there's business interruption linked with that, then they would see that you effectively you're ending your business, or at least the business at that premises, at the point of any loss that's going to be in excess of that figure. So it is an interesting case study. Unfortunately, I don't get involved in the selling side, so to speak. But certainly on business interruption, we generally see first limit of loss type policies for that type of scenario. So if you have an example where perhaps you've got a business that's got 20 different locations, you as a risk manager might think, well, actually we're only ever going to have a loss at one location. You'd have examples like disease where that might not be the case, but you might be prepared to accept the risk that you'd have a loss at more than one location, and so there is something called first limit of loss cover, which would mean that rather than covering, I know, £20 million across 20 sites, you only need to buy the cover for £1 million worth of cover. And obviously the premium on that would be more expensive than buying £1 million worth of cover at one site, because there is the increased risk that there is going to be an occurrence somewhere in that portfolio of 20. And so you would have to make sure that the declarations of the details on the statement of facts are correct, and so that underwriters appreciate that it is a £20 million business over 20 sites, and not a £1 million business at one site. And that's the sort of thing that adjusters will be checking at the time of a claim. The last point on this slide, it talks to sort of length of cover, and so what we have on the policy is something called the maximum indemnity period, and that is the period that insurers will consider those business interruption losses for. And so if you imagine having the loss on day one, that immediately triggers a business interruption, and you then have up to 12, 24, perhaps even 36 months worth of coverage. And you've either got all the way until then, or until more likely is the date at which the business returns to normal trading. Generally, that works really well. The scenarios that it doesn't work well in are if there is any level of subsidence. So if it's a claim for subsidence and there's a requirement for protracted monitoring of the building before any kind of reinstatement works happen. Technically, the indemnity period starts the day the cracks or whatever damage were identified. And if you've only got a 12-month maximum indemnity period, and it's going to take 12 months to monitor before you do any building work, then you can see that you're going to run out of that cover before you need it. The other thing you need to consider, really, and I suppose this links in quite well with Stephen's comment about the church. Any kind of historic building is going to take a substantial amount of time to rebuild. And so whilst you might believe that the business can recover very quickly within a 12 month seems to be the sort of standard coverage that people buy, it could very well be 18 months before you've got the building reinstated, and then you're going to want to have the benefit of remaining periods to be able to recover the business and recover to normal trading. You'll also be aware that if health and safety executive get involved for any reason, if there's a death or injury on site, that's potentially going to protract the period that any works, any investigations into the remedial works can start. And so anything like that might apply in your type of business can all add to that length of time. Number one recommendation on this would be go for the longest period that you can. I don't see how much that affects the premium cost, but certainly the longer coverage you can buy, the better, really. So a couple of case studies that we've had. So this was quite a prestigious school. They had a sort of a building that had a swimming pool at the bottom, with saunas and changing rooms, and then at the upper levels they had a gymnasium, as you can see there, classrooms. The loss happened, if I recall correctly, in sort of the October-November half term. It was during school holiday period, which was fortunate. However, they within a short period of time had to welcome their students back, educate them, and therefore the sorts of things that we were able to use increased cost of working for in order to mitigate the longer term loss were making sure that we had cleaning contractors on site 24/7, spending money in order to expedite those kind of works. We used increased costs of working to ship the children to a nearby swimming pool so that they didn't miss out on getting their swimming training in. We were able to do things like the indemnity payment for replacing or repairing and cleaning IT equipment. We were able to effectively subsidize the replacement rather than the cleaning and reinstatement of that equipment. And so ultimately there was no loss of revenue on this one. It was sort of seven figures by quite a significant amount, but ultimately, and that was on the property damage side of things, including the ICW. But ultimately, the school is now, it was an independent school, is now trading just as it would have expected to prior to the loss. The cause in that one was, in fact, the previous slide. That was the seat of the fire. You can see the sauna heater unit there. The one on this screen is a similar model and type, and it had been moved too close to the wood paneling, and you can see there'd been a near miss on this neighbouring sauna unit that resulted in scorch marks. Effectively, the wood had set light and then set light to the rest of the building. The other case study I've got is we dealt with a fire at a large cheese manufacturer. The loss happened at their warehouse and processing site. So I think it was something like 700 tons of cheese they had. So probably one of the world's largest fondue sets. But ultimately, we were able to work with the insured in that case to mitigate the loss by various things like marketing, additional marketing expenditure, buying in replacement goods to a certain degree. But obviously, if you're the manufacturer and you make sort of a bespoke or a product that's unique to you, it's limited as to what you can buy in from other locations. So for my audience this evening, if you are involved in dealing with the insurance side of things for your business, things that I'd really like for you to take away from this is really that if you can learn from those sort of common mistakes that I've highlighted in the talk, engage with your brokers throughout the renewal or the placing process, making sure that they're fully aware of the risks that your business that you're wanting to transfer. Most of us will have specific ideas in mind as to what fairly unique risks might be posed towards your business. Talk through those. And this is where business continuity plans, or business continuity planning really helps you, in that the plan, the documented plan might not necessarily cover the scenario that you find yourself in, but it will have forced you to go through the thought process of what risks there might be out there. And as risk managers, you'll have a whole suite of tools that you use anyway. But if you think through that, you can think about, well, what additional covers do we need within the policy? So I talked earlier about the utility supply. I've talked about sort of the customer supplier extensions, but it can go beyond that in terms of, well, if we do have a loss, knowing that we have coverage under the business interruption section for this kind of thing, how might you want to suspend those increased costs of working? And that's where it comes into sort of knowing your supply chain. If you've got sort of a single supplier for a type of your type of products that you need to buy in, look at dual sourcing. Look at if they have a fire, where else can you go? If you have a fire, can you outsource your element of production to either a competitor, a business that might do something similar? And I know sometimes that can be a bit of a double-edged sword. I know I've dealt with printing businesses whereby I've dealt with printing businesses where it's a very cutthroat industry, and to the extent where our insured outsourced some work to a competitor, and the boxes of the finished products all came through with business cards from the outsourced supplier. So there are risks inherent in doing that, and it's really about making sure that you're aware of those as part of the process. And really the sort of key takeaway would be those sums insured and maximum indemnity periods, making sure that you understand how they're set. You've referenced back to rates of gross profit is a key one really in setting those. So James has highlighted the disruption at Heathrow Airport. So we've got a couple of claims from that that are sort of going through, and it really does depend on what the policy wording say. That type of scenario, so that was damage that occurred at a substation, so that is a type of loss that would get picked up by the generally more prevalent type of wording. But if you're on something like a terminal ends type coverage, then that again would be picked up. So that pretty much wraps up my talk for this evening. We've had some good questions, comments throughout. It's really just an opportunity now for anyone to raise any questions. I believe that there is going to be a recording shared afterwards. And as I say, the intent of this session was not to sell you anything, and I hope for your sakes that our paths don't cross in future. But we are here if that does occur. and I'm happy to take emails if anyone has any follow-up questions afterwards. So I'll hand over to you, Peter, unless there's any questions.
Brilliant. That's always interesting to have a see risk from a non-health and safety perspective and see how it opens other thoughts that wouldn't normally be looking into. So we'll be definitely trying to think about how to mitigate for the worst in our own offices. As I say, if you've got any more last minute questions to get in there, feel free. And you've got a lot of appreciation coming through on the chat, which is always good. Again, just a reminder, keep an eye on the emails. We're planning a little get together in November before the Christmas crunch starts getting on our calendars. But again, effectively, thank you very much, everyone, for your time coming here tonight. So I hope to see you at the next one. And again, thank you very much, Angus, for giving us your time and your knowledge.
Thank you very much.